Welcome to Fear and Greed, the week ahead. I'm Sean Aylmer, and as always, I'm joined by economist Stephen Koukoulas. You'll find him at thekook.com and .next using the handle thekook. Stephen, good morning.
Good morning from a chilly Melbourne. It's cold here this morning.
Oh, I've got to ask you a question here. Now, last week, Oxford Economics came out with their top 1,000 urban areas to live, and they had 5 categories, economics being the main one. New York came in at number 1. London came in at number 2. Number 9, best of the Australian cities, Melbourne. Would you agree?
I can't argue with that. It's a great city. I'm glad I've moved here, not just for the fun, the culture, the restaurants, the cafes, but the sport, the horse racing, just the general atmosphere. And it's just the weather. I like the cool weather. So even though I'm semi-complaining about the cool weather, it's superior to the hot and humidity that you get in other places.
Well, you have lived in Melbourne over summer, though. You have been through a Melbourne summer, and that's pretty hot.
It is hot, but thankfully we've got the power generation going on, so the air conditioning and those sorts of things can sort of keep the temperature lower while you relax, watch the tennis, watch the cricket, and do those other nice things that happen in Melbourne.
Just quickly, last week we had the Reserve Bank minutes. Did we learn anything new there, particularly given we've had a fair bit of information since that meeting?
Look, I think we learned nothing, because the critical words in that statement, that's all due respect to the RBA, because they did have their analysis of the economy, but there was this throwaway sentence: these forecasts do not take account of the upcoming federal and state budgets. And as we know, a week after that board meeting, we had the federal budget, and that included the measures on electricity subsidies, some rental subsidies, some other payments and issues too. So without being unfair to the RBA, those numbers and those minutes were obsolete, because the budget included a whole lot of measures that had an impact on the measured CPI, an impact on the extent to which fiscal policy is just giving a little bit of a helping hand to the economy as 2024-25 financial year kicks off.
Okay, this week we've got plenty of information coming out in terms of how the economy is travelling. Let's start with the monthly inflation figures. What do you expect from them?
Yeah, really important. Of course, inflation. They're the three main issues for the RBA right now. It's for the month of April, and we know petrol prices went up. This is probably the only downside of monthly inflation numbers as opposed to quarterly inflation numbers. They pick up a lot of noise. So we're expecting the annual increase in monthly inflation to April to pick up to around about 3.7, 3.8% from 3.5%. But basically, all of that pickup will be due to the fact that the oil price kicked up in the month of April. This is where it's one of those times when you look at the trimmed mean or some of the underlying measures of inflation to see whether we've got another little step down. But either way, it's going to be really, really important to sort of see where that inflation momentum is.
Okay, now the household is hurting. We know that. The Reserve Bank knows that. This week we get retail trade figures as well, which is a partial indicator of how households are travelling. It's kind of not a good story, is it?
It's not. And in fact, when we look at the economy overall, things like business investments doing okay, net exports are doing okay. We know the government sector, both state and federal, are spending money, so that's adding to the economy. That really weak part is the consumer. It is the household sector that we consumers, we're savvy beings, if you like, that we respond to cost of living pressures. We're responding to the fact that rents are going up. We're responding to the interest rate hikes that are being delivered, and we're responding in a way which means we're spending less. So we're expecting a really soggy, weak retail sales number for the month of April. Again, there's a little bit of issues with the seasonality from the ABS. I think Easter fell in April this year, which can cause some quirky numbers. But the bottom line is, Sean, retail spending is flat to weak, and that's where the hole in the economy is.
We saw that last week. There were a bunch of companies like Bapcor and Eagers and some of those guys have all come out and just said that it's really soft out there. You mentioned business investment then. So we get CapEx numbers out this week. That's interesting. What is the mechanism, though? Why do you have weak household spending, yet businesses still happy to invest? I don't quite get that.
Yeah, for the business sector, and of course they are vulnerable to interest rates too. You know, most businesses I know have an overdraft or they borrow money to fund their expansion. I think every business has debt. So they are hit by the high interest rates as well. However, they've got a threshold to grow their business. They've got an objective to make sure that they've got the best IT, they've got the best artificial intelligence, that they're not falling behind their competitors. And interestingly, this is still part of the reason why I think CapEx is doing reasonably well, in fact, quite well. There's a catch-up from the COVID pandemic. We heard many stories of businesses saying, I need a new van, I need new machinery, I need new equipment. But because of the supply chain problems, they couldn't get it. Now, in this year or two since the pandemic has ended, if you know what I mean, they've said, well, I still need that machinery. I still need to invest in transport. I still need to invest in warehouse distribution because we're buying more and more stuff online. And that's where the CapEx is supportive of the economy. So, we're expecting a modest increase in CapEx for the March quarter, which feeds into the March quarter GDP numbers, which come out next week. But business investment, the vital link for getting productivity back up. So, if we don't get a pickup in business investment in the next 12 months, it's another sort of, just a negative thing on the productivity outlook, which we don't want. We want productivity to improve.
And let's stay negative, Stephen. Why not? It's a Monday morning. Building approvals. Oh, God.
Oh, that horror story. I can't think of a polite way of putting it, but we know that at a time when we do need more houses being built, I don't think anybody disagrees with that. And we had the debate emerging in the political sphere about immigration targets and all that sort of stuff. But without getting into the nitty-gritty of that, even with the lower immigration targets that the opposition parties are proposing right now, we still will have a big shortage of housing. And so the building approvals numbers, we need to see them. We must see them picking up because they're currently running at a level that's about 35-40% in annualised terms below that target that the government's got to build 1.2 million dwellings over the next 5 years. And unless we start getting a wriggle on now, like really, really soon, there's just no way they're going to meet that target. So here's hoping we see a pickup in building approvals, but alas, I think we're going to see another pretty soggy result.
Enjoy the week, Stephen.
Will do. Thank you.
That was economist Stephen Koukoulas, better known as The Kouk, Thekouk. You can find him at thekouk.com and follow him on X using the handle The Kouk. I'm Sean Aylmer, and this is Fear and Greed, the week ahead.